Good evening and welcome to the third episode of the No Nonsense Investor. The market is in a real slump and many global indices are down double-digit percentages from previous highs, and some funds such as Cathie Wood's ARK Innovation Fund have lost over half their value. Unfortunately, while institutional investors have taken a hit, retail investors are often the biggest losers, especially those with little previous investing experience. So today's episode is how not to lose money, and we're going to focus on the 5 biggest pitfalls that cause new investors to lose money, and then with the wisdom of some of the greatest investors in the world, we're going to learn how you can avoid those pitfalls. Anyway, to business. The first way not to lose money is don't invest in things you don't understand. It's essential to understand what you're invested in and why. What does a company do? How do they make money? How predictable is it? And why are you investing in it? If you can answer these questions before making any investment, it could prevent you making a lot of terrible investments right off the bat. Another reason this is important is psychology. Any investment is certain to crash in value from time to time, no matter what it is. And when you see the value of your investments drop, as many new investors are seeing now, knowing what you own and why will help prevent you from making bad decisions such as selling at the bottom of the market. Warren Buffett's the most famous investor in the world, and he's often said it's important to only invest in things that are within your circle of competence. In his 1996 letter to shareholders, he stated that what an investor needs is the ability to correctly evaluate selected businesses. Note that word, selected. You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important, but knowing its boundaries, however, is vital. One look at Buffett's portfolio shows that he invests in predictable companies that are easy to understand. Apple sells smartphones and computers. Coca-Cola sells fizzy drinks. MasterCard is a credit card company and processes transactions, etc. Predictable, reliable, and easy to understand. But can the same be said of an obscure biotech stock or a collateralized debt obligation derivative? Of course, everyone has different circles of competence. A scientist, for example, may invest in an obscure biotech stock because they understand the sector very well. A hedge fund may invest in collateralized debt obligations because... Actually, Bear Stearns had no idea what they're invested in either. The moral of this story is know what you own and why you own it, and don't invest in things you don't understand. If you're enjoying this video, please subscribe to the channel and smash the like button for the YouTube algorithm. I can't grow the channel without your help, and I really appreciate the support. The second way not to lose money is don't try to time markets. British investor Terry Smith once said there were 2 types of people when it came to market timing: people who can't do it and people who don't know they can't do it. Trying to buy low and sell high sounds great on paper, but it's impossible to do consistently in reality. Not only is there no announcement at the market top or bottom, you also have to guess right twice. Not only to sell at the top, but also to buy in at the bottom. Markets are also not well correlated to sentiment in the news. For example, if you'd have been told in January 2020 that in the next few months there'd be a global pandemic that would kill 1 million people and result in a shutdown of the economy in most countries, you'd likely have sold all your stocks and gone into cash, and this would have been a rational decision at the time. But had you have done this, you'd have lost out on a rally of epic proportions which followed. In fact, it seems impossible to predict how markets will react to macroeconomic events. The stock market is a very strange place. Usually in a market, if goods go on sale, there are more buyers. But in the stock market, people sell when prices go down and buy when they go up. It's a sort of reverse physics which often wrong-foots people who try and time it. A well-known calculation exercise was done comparing 3 investors who each invested $96,000 over a 40-year time horizon. The first was terrible at market timing. They saved up their money and they invested it at the worst possible points in market history, right before the crashes of 2000 and 2008, for instance. The second was a great market timer and saved their money before investing it at the best possible points in history at the bottom of those dips. And the third was someone who didn't try to time the market and simply invested slowly and steadily. The results were interesting, to say the least. After the 40-year time horizon, the bad market timer had turned their $96,000 into $663,000, while the best market timer had turned it into $956,000, so only 40% more than the worst market timer. The winner was the slow and steady person who didn't try to time the market and simply invested money slowly and steadily, at the highs and also at the lows. Slow and steady meant they were fully invested and didn't have money on the sidelines earning a low rate of interest at any point in time. It seems what matters is time in the market rather than timing the market. The third way not to lose money is don't overtrade. We often hear the aim of investing is to buy low and sell high. However, there's a far more successful mantra: buy well, sell never. This is because great businesses compound in value over time, and the benefits of that compounding are only fully felt after many decades. The investor Peter Lynch used to say run your winners, and was known for picking 10 bagger stocks which multiplied their value 10 times during the holding period. This is where the real money is made in the stock market. If you sell a stock because it's gone up 20%, you'll lock in a gain and may feel happy taking the profits, but you also limit any further upside. Imagine you invested in Adobe software when it floated back in 1986 and then sold it for a 20% profit. Nice, but then imagine checking Google in November 2021 and finding out you missed out on gains of over 301,000%. Forget 10 baggers, Adobe turned out to be a 3,000 bagger. Apart from missing out on the magic of compounding, trading also incurs significant fees. There are the fees charged by the platforms, the bid-offer spread, which is the difference between the buy price and sell price of a stock, which is often underestimated, especially for less liquid stocks such as small caps. There's forex fees for changing currencies, taxes such as stamp duty, and if you turn over your portfolio significantly each year, a considerable chunk of any gains are eaten up by those trading costs. Doing nothing is often the hardest thing to do in investing. It seems like the entire financial media is geared towards generating trading activity. Buy this, sell that, as though performance is linked to trading activity when it actually isn't. Smartphone apps mean we can check our portfolios every 10 seconds, but in reality, we'll be better off turning off our phones and letting compounding do its thing over the long term. The moral of the story is don't overtrade. The ideal holding period is forever. The fourth way not to lose money is don't overpay in fees. It's essential to keep your fees as low as possible. This is because the fees you pay, like the gains you make, compound in value over time. Jack Bogle, the legendary investor who founded Vanguard, said that before costs, beating the market is a zero-sum game, but after costs, it's a loser's game. Fund performance comes and goes, but costs go on forever. Here's a chart from Vanguard which shows the impact of fees on your wealth. Imagine you have $100,000 invested, and if the account earns 6% a year for the next 25 years and had no costs or fees, you'd end up with about $430,000. If, on the other hand, you paid 2% a year in costs, after 25 years, you'd only have about $260,000. That's right. The 2% you paid every year would wipe out almost 40% of your final account value. 2% doesn't sound so small anymore, does it? This is one of the reasons hedge funds have consistently failed to beat low-cost index funds over recent years. The hedge fund fees, often a flat fee of 2% and then 20% of any gains, often known as 2 and 20, eat away at any performance they generated. Here are some examples of low-cost index tracking ETFs. As you can see, all cost less than 0.1% each year, and these are what I would personally regard as inexpensive for fees. And although he may not be an investing guru, I think the comedian John Oliver summed up the impact of fees very well. He said fees are like termites. They're tiny, they're barely noticeable, and they can eat away at your future. If you think we've missed any key ways to avoid losing money so far, please leave a comment in the comment section below. It would be great to build up a discussion on the topic. And remember to click the bell to subscribe and smash that like button for the YouTube algorithm. And now to the fifth way not to lose money. Don't engage in greater fool theory. Greater fool theory argues that rather than looking at the fundamentals of an asset, such as the valuation, the returns on capital, margins, and intrinsic value and the likes, that you can make money buying assets you know are overvalued simply because there'll always be a greater fool willing to buy them for a higher price in the future who you can sell them to. This is of course risky, as eventually the market runs out of additional fools and the price drops as everybody sells out, collapsing the house of cards. The risk is that you end up holding the bag, as it were, once the supply of extra fools dries up. The bubble pops and assets sink to their fair valuation, which will be much lower than it was at the peak of the bubble. One example of greater fool theory was the dot-com bubble in 2000. The dot-com bubble saw a barrage of new internet companies floating on the stock market. Most of the companies didn't make any money, and many would never go on to do so. But the speculative fever was so high that investors rushed in to buy the stocks, believing that because the internet was still in its early stages and would go on to become huge, the next person would surely buy the shares at a higher price. One example of this was Pets.com, which went public in February 2000 at $11 a share. Those who got in early were able to sell to greater fools at a high of $14, but the business wasn't sustainable and the fundamentals were non-existent. The supply of fools dried up and Pets.com stock quickly fell below $1 and stayed there until it eventually filed for bankruptcy. What's interesting here is that the internet did go on to become an all-encompassing part of our lives, but that didn't mean all internet stocks went on to do well. Only those with sound fundamentals and business models turned turned out to be the winners and many went bust. It teaches us that you can be right about an overall trend or technological advancement and still fail to predict which particular investments turn out to be the eventual winners in the space. It's important to remember that bubbles are often only recognised after they pop. It sometimes seems as though nobody cares what they're invested in when the numbers are going up, but when values are rising, all investors seem like geniuses, and accusations of greater fool theory are often rebuked. Another modern-day asset class which has rightly or wrongly become associated with greater fool theory are cryptocurrencies. Assets which, despite their stellar price gains in recent times, have been criticised for having zero intrinsic value. In 2021, a new alternative meme coin named after the TV show Squid Game appeared on the scene and immediately shot up in value. Many investors piled in thinking the price would keep rising and they could likely sell it to an even greater fall in the future. However, the coin turned out to be a scam and the price went to zero. Many investors were left without so much as a bag to hold. It could be said the investors who bought into Squid Game cryptocurrency were participating in greater fool theory. The coin had no intrinsic value and they hoped to sell it to someone else for a higher price in future. It's worth questioning at this stage whether some other cryptocurrencies might go the same way as Squid Game and the dot-com stocks. What will happen to their valuations should holders take profits and the supply of new buyers runs dry? The alternative to greater fool theory is to invest in great businesses that you'd be happy to hold forever. Warren Buffett once said we should only buy something that we'd be happy to hold if the market shut down for 10 years. For instance, companies with great fundamentals that compound in value over time. The moral of this story is there's more to investment than finding fools. So in today's video, we've looked at 5 ways to avoid losing money. Don't invest in things you don't understand, don't try to time markets, don't overtrade, don't overpay in fees, and don't engage in greater fool theory. I hope you've enjoyed today's video, and if you did, please smash the like button for the YouTube algorithm and subscribe to the channel. There are plenty more videos on the way. And of course, no nonsense.